What's up, guys? Welcome to another episode of the DGen Radio Podcast. I'm your host, Thiago Vilela, and today I had a great conversation with Ramiro and Vish, co-founders of Strata. Strata is a risk trenching protocol, and the episode was pretty complete. We talked about everything Strata, about market events, risk management, and a lot more. There's a bunch of alpha here, so let's hop into the episode. Hey, Ramiro. Hey, Vish. It's glad to have you in the show. Welcome. And
I'm
man,
here.
before we start, can you give like a brief introduction to yourself? How did you start in crypto and why did you start Strata? Let's start with Ramiro here.
For sure. So, I'll do it as brief as I can.
Right.
I'm originally from Argentina, so I got into crypto, I would say, back in 2015, 2016. Capital controls back at home, Bitcoin a really good way to move around that. So I started exploring a bit more of the asset class, brokering in cash, Bitcoin against sort of US dollars back at home. Then sort of 2017, 2018 happened. I was working as a valuations analyst at a big sort of arbitration firm. And I was delving into ICO sort of in the launch time and after work. Um, and that, yeah, they started getting really, really interesting. I made a bit of money out of that. Left Argentina, so went to Cyprus, then to London to work at in two brokers. TradFi side, nothing to do with crypto, but always stayed kept an eye on everything. And then finally 2020 came, and I got the chance to start diving into the space in a full sort of commercial role with a Swiss firm that was selling CeFi infrastructure. White label exchanges or trading, custody, liquidity to multiple sort of centralized exchanges across the world. And then DeFi 2020 summer happened, and then I started going deep into it. That's been the history since. Did work with a bunch of protocols to help them on the go-to-market side, with the previous sort of group of developers when they were developing several sort of DeFi primitives and DeFi projects for several foundations. I was essentially helping on the product ideation all the way to post TGE, and that was around 3 years. That's how I met Vish. He was in Polygon, and I approached him with my other co-founders to essentially onboard onto the lending protocol that they had. And I think that one thing led to another. We had a good relationship, and then when he moved to Neon, I onboarded into his team to lead DeFi there. And since earlier this year, we started working on Strata. And that's been the TLDR. So I let Vish continue, and then we can start talking about Strata.
Yeah, let's
Yeah.
go.
Thanks for having Strata on the show, and really great to be here. On my side, I have been in the space since last, I would say 4.5 years. Before that, spent almost like 3.5 years in traditional finance. Started my career with Goldman Sachs in Singapore, focusing on systematic trading strategies, and then moved to the buy side of the business, joined a UAE-based single-family office. And during that time, I would say around early 21, when it was really sort of difficult to ignore digital assets. So worked, I would say, sort of co-managing the fund that we sort of launched within that family office only. We're doing everything, like systematic trading strategies on blue chip assets, funding rate arbitrage, DeFi, yield farming. So I would say did everything. And it's like professionally, you can say, when I was introduced to digital assets. And since I come from, I would say, engineering background, so always wanted to get close to the chain, to the infrastructure. So joined Polygon, their DeFi team, then worked with a DeFi focused venture studio, then led Neon's DeFi team for almost like 1.5 years. And since I would say April this year, just been focusing full time on building Strata. So yeah, I mean that's basically TLDR on my side. Yeah.
And this is the first podcast we're on, Tiago, by the way. First public appearance.
That's great, and I'm happy that it's the first time it's here in the show, man. I'm really happy. I like you guys already know that I'm excited about Strata and the intersection between traditional finance and crypto. So yeah, can you guys explain like what is Strata for those who are not familiar with it?
Yeah, sure. So Strata is basically, a perpetual risk transfer protocol that is designed to offer structured yield products on top of any crypto native yield. So essentially, what the protocol does is it transforms the underlying, I would say, yield strategy into two tokenized tranches, senior and junior. Senior is essentially a overcollateralized yield-bearing dollar that provides principal protected yield that are floored at a benchmark rate, and while retaining the uncapped upside to the underlying yield. And on the junior side, it's essentially a yield-bearing investment product, or you can say like a liquid insurance pool that underwrites the risk of underlying yield going below this benchmark rate. So essentially, that's basically the volatility risk that junior underwrites, as well as it underwrites the underlying protocol or collateral risk, or you can say the counterparty / credit risk, and in return it receives the leveraged upside to the underlying yield source. So overall, the idea is to transform the one size fits all yield products into two composable products that are sort of designed for two distinct risk reward profiles. So that's basically strategies.
Cool. Yeah, it's Pendle was the first step, like getting like some kind of fixed yield into crypto, and now you guys are coming to like a next level. Let's say like this. It is a question I get a lot. People asking like, so how I need like some fixed stuff, and every yield's variable. So predictability is something that's very important to a lot of people. That we in crypto don't give like a lot of importance. Use it, we didn't used to until like I think 2 3 years ago. And all right, so can you now go a little bit back to how like what is like a risk crunching in TradFi, just to those who are not familiar with it in crypto. Like most of my audience is very crypto native, so not everybody has like a finance background and they don't know all the products. Can you go a little bit on this and like how does it work in TradFi, and bring some analogy to
Yeah.
help clarify this how it works?
Yeah. So yeah, I mean, risk tranching is sort of new primitive in DeFi, but it has been existing in TradFi, I would say since last 30 35 years, even more than that. And it's, I mean, basically securitized products. They are, I mean, if you talk about the market size, almost like 10% of global fixed income market, which is something like 15 16 trillion dollars right now. And the most common, I would say, risk transfer products that exist in TradFi are asset-backed security, mostly like MBS, CLOs, CDOs. So essentially, they repackage different kind of fixed income instruments, like bonds, or you can say basically like corporate bonds, or even different, I would say, more exotic treasury bills, as well as more like personal finance loans, so something like that. And the idea is to sort of create a basket of different assets across the risk spectrum, and then repackage them and offer them with different tranches, basically the senior tranche is the safest way. So if let's say some underlying bond, it defaults, so senior is protected from that default risk, and in return they receive basically I would say the lowest yield in the waterfall structure. And then you have like a mezzanine tranche, and then you have junior tranche. So junior tranche is the most risky one, so and it acts as the first loss of capital in the whole structure. So if any underlying bond defaults, the first loss is
the junior.
It goes to the junior tranche, and whatever sort of remaining, it goes to like
Right.
like the waterfall structure. So overall the senior tranche is paid first, and whatever you can say the shortfall is covered by the mezzanine tranche, and further towards the junior tranche. So yeah, I mean, this kind of structure being I would say very popular in TradFi. Senior tranche is more suitable for risk averse investors, like sovereign wealth funds, or you can say big institutions, institutional asset managers like pension funds, those who are looking for the the yields that are better than I would say TradFi benchmark rates, but at the same time they have very, I would say low risk exposure to these yields. And junior tranche, again, suitable for more like risk tolerant allocators, like hedge funds, family offices, that are sort of looking for alpha in the market, and with that they are ready to take the extra risk that comes up with the structure.
Yeah.
So
So
yeah.
so effectively, if for those like that still didn't get the message, if you want like low risk and like lower rewards more like constantly, you go to the senior tranche. It's like it's a fixed yield, but to attach it to a benchmark. And if you want more risk, you go to the junior tranche. And on the junior tranche side, it's higher risk, higher reward. And is this like a do you guys right now, you guys has only the USDe product live, right? And if you, let's say you're gonna build like another layer to that, if you're gonna add another layer to that, and is are you guys like doing the creating the products, or are there like risk curators creating it?
Okay. So yeah, so far, I mean, our model is, I would say, the protocol, the model, everything is, modular. So essentially, senior always pays a risk premium to the junior side, and this risk premium depends on, like how much liquidity is deposited on each side. Essentially, the risk is being priced, by the market. So the same model can be applied to different yields. There are few parameters that can be changed depending on the underlying yield source. So right now everything has been done in-house, the risk management part. But eventually, as we grow and we integrate more yield sources, we want to sort of outsource, you can say, like changing these parameters to I would say you can say DeFi native risk managers. I mean, the model, the way it works is pretty much similar to how interest rate curve work in Aave. So depending on the underlying market, few parameters, risk parameters can be changed. Very similar to Aave. So we will have like these risk managers as service providers that actively work on the fine tuning the risk model.
Got it.
So to add to that, Tiago, what you see now is basically we have the USD product, like you said, but the idea is to scale horizontally and add more products to essentially become a modular platform. So the UI that you see now is going to be evolved, and it's going to have a series of different strategies and a series of different products. And from USD, we're moving to sort of some that we can say, for example, HLP, and others on other, for example, on other EVM chains, or even on mainnet, right? So the intention is to build the same risk tranches, but on multiple yields, USD, but also non-USD assets and non-USD strategies. You can have ETH, you can have BTC, you can have HYPE, for example.
Yeah.
So
This
that's
is
a bigger picture.
this is interesting, and I think we're gonna deep dive in this later on. And all right, so going a little bit like back on the regulatory side, actually, never mind. Before we go into the regulatory side, and I got a few questions like when the first time like I read and talk about Strata, a few people asked me, is this like a competitor to Pendle? And can you explain the differences between Strata and Pendle, and if you are or not a competitor? And besides that, do you have any like other competition in the market right now?
Okay. So, I mean, just to answer, this question, we are definitely not a competitor to Aave. I mean, broadly, both are building, structured yield products. But
Pendle.
fundamentally,
It's Pendle.
to Pendle, to Pendle, yes. But yeah, fundamentally, the products are, I would say completely different. So on Pendle, you have basically principal on one side, yield on another side. In Strata's case, you have principal on both sides, you have yield on both sides, and on junior side, you have yield risk, right? So essentially, basically the way it works is, so I mean, if you look at DeFi ecosystem, you know, like especially in lending, protocols, these fixed rate, fixed term lending protocols, they haven't achieved product market fit yet, right? And the that I would say the most of the lending protocols, they are based on utilization based lending, and it has clearly achieved the product market fit. So overall, we think that the DeFi users, they demand sort of predictable yield, but at the same time uncapped upside to the yield, not like very restrictive, like you get fixed yield at 10% even if the underlying is performing at 20-25%. That's what basically you can do with Pendle PTs, right? And another thing I would say, in Strata's case, basically you keep the uncapped upside, and you get floored APY that is linked to the benchmark rate. So that's, I would say, key difference. I would say another thing, I mean, Pendle, they have all the PTYT, they are based on fixed maturity. In Strata's case, there is no fixed maturity. Both senior and junior tranches, they are perpetual. Another difference, I would say, Pendle is just tranching the yield. Basically, you can say they are sort of the YT sort of takes the volatility risk, and PT side, they get the fixed yield. So all the volatility risk is transferred to the YT side. In Strata's case, senior transfers the volatility risk as well as the underlying counterparty or credit risk, you can say. So let's say something goes wrong with the underlying yield source. God forbid it does not happen, but let's say USD or Ethena goes insolvent at some point. So junior acts as the first loss of capital. So let's say something goes wrong with Ethena, and they are not like fully solvent. So whatever basically the loss is first goes to the junior side, and whatever remaining goes to the senior side. So essentially, it becomes the safest way to access the underlying yield that is protected from this volatility risk, as well as the underlying collateral or protocol risk, you can say. And I mean, this is not this part is not really sort of integrated in Pendle. So in summary, I would say Pendle is designed for yield trading, and Strata is designed more for, you can say, yield investing. So we are making yield investable, and Pendle is making yield tradable. So I would say in terms of users, I would say completely different, and even in like yield sources, we want to grow, with very strategic, underlying yield sources, but eventually, we want to scale horizontally and want to build like a distribution layer on top of existing yield sources, very similar to, how, Pendle did. So that's, I would say, like similarities as well as, differences. Just to add one more thing, I think, basically we work very closely with Pendle, and we both realize the value of, like how Strata and Pendle together, they can give rise to a new era of, structured yield products. So just to give an example, right, let's say, Athena's yield are below, the benchmark rate. So on junior side, you can have, let's say, negative yield for some time, because essentially you are underwriting that risk of, Athena's yield going below the benchmark rate. But, you can hedge, those negative APYs with, the fixed yield on PT side, or like LPing on, basically, Pendle market on junior USD. So, I mean, it gives rise to, another, I would say, structured yield products. Like on YT side, it's not really, composable, but, our junior tranche, which is essentially sort of broadly similar to, YT side, but fully composable, already integrated across, multiple, I would say, money markets. So overall, we are more complementary than, competition, I would say.
Yeah, it's more complementary. Got it. And I think people confuse this because when you're saying splitting yield, and they all go like straight to Pendle. I think that's why most people like get confused about it. So you don't have any like competitor like doing the same thing you guys are doing live right now?
Right now, I think, you can say the closest competitor would be Resolve, because, they basically sort of cloned Athena with inbuilt, risk tranching. But for Resolve, it's like a feature, for us, it's a full-fledged product, They are building a stable coin, a digital dollar, with inbuilt risk tranching. But we are not restricted to, just building a digital dollar, but like a full-fledged, risk tranching, as you can say, more like a platform,
I think you cannot say Resolve or like kind of competitors to you guys. I think it's just they're trying to be a competitor more to Athena than to
So exactly.
It's I think it's the feature that we get a lot of users on the community, and in terms of like investors or power users, funds asking, what is exactly the difference. So I think Vish mentioned it, right? It's essentially the feature versus the product, right? So on our case, it's, Strata is fully decentralized protocol, set of smart contracts. There's no active management of the underlying, right? We're not looking to create a new yield source, but we're looking to enhance existing yield source to create this sort of tailored risk reward exposure. So both conservative and sort of risk-taking investors can access in the best way possible, and move away from what you see now, that it's just a lot of one-size-fits-all sources of yield that are not, I would say, compatible with every single,
got it.
individual, investor preference.
I think it was clear, like it's a pretty big difference between like a managing quote unquote the yield and like managing the stable coin. And now moving on to the regulatory side, and you were seeing like the stable coin boom in the US, like Secretary of Treasury Scott Bessent saying that he's seeing like trillions in stable coins come to market until 2030. We had the Genius Act passing. There's the Clarity Act on Congress. I think it's on Congress. I'm not sure. And in how like a lot of institutions come into crypto, how like do you see like how big of a role did this change in the administration, in the regulatory side, and in the US impacts like the creation of Strata, and like how will you guys look into the market moving forward?
So I mean, definitely, after Trump was voted in, and the government is more, I would say, pro crypto, and all these recent regulations, they sort of there is more clarity around basically stable coins, yield bearing stables. I would say 2 years back or 1 year back, everyone was in dark, like how does the regulations will look like, whatever I'm doing is compliant or not. But at least now we have clarity, like what is compliant, what is not compliant. And I think it has given a lot of confidence to institutions or the kind of users that have been holding up on coming on chain because of all this regulatory unclarity we had. So definitely it has played a key role in the digital dollar adoption that we have been seeing recently. And basically it has provided this Clarity Act, and especially the Clarity Act, it has provided more clarity on yield bearing stables as well, like what can be offered, what cannot be offered. And like in our case, as long as the underlying yield is compliant, the products we are offering should be compliant. Essentially, we are just building a distribution layer on top of it, which is fully on chain. And like even if, let's say, we have some sort of unclarity, like to which investors these yields they can be offered, we sort of sort of like fully transparent on our you can say terms of service, and we sort of do not allow our front end to be accessible from countries that are sort of excluded, or should not be have exposure to basically these you
Sanctioned
can say
countries, right?
sanctions country, exactly. So yeah, in summary, I would say, yeah, as long as the underlying yield is compliant, our products built on top of it are fully compliant as well.
Yeah, well, I would add, I don't want to go too long on this, but I think that
Right.
stablecoin adoption is like way beyond the US only, right?
Yeah.
The US is just coming in, but maybe in Brazil, you guys don't see that much because the Brazilian real, like it actually serves
It's
as a
bad.
currency in a way. It's not as
Yeah.
well. Come on,
It's not as
no,
bad. Yeah, it doesn't compare to peso. Yeah, it's true.
So when you don't have a currency and you're talking about peso, but the lira or maybe like the naira, right? So the stablecoin adoption in those countries has been, it's huge, right? I'm talking about billions. So once those users start looking into ways to not only, because right now they're saving, and that those savings are just being eaten by inflation. Once they start looking for yields or like passive savings on those stablecoins that they have already collected after years of essentially replacing their day-to-day like broken currencies with private, more efficient on-chain money, then that's when sort of crypto native yields come in place, right? So we see that those sort of savers are going to start looking for, I would say, conservative ways to store their capital, and not just fully volatile, or the sort of risk on yields that you see today in DeFi.
Got it. Yeah, I actually didn't mention like emerging markets because like as we're both from like that South America, I'm from Brazil, you're Argentina, and we're both like have inflation problems. Of course, like Argentina was way worse, but Brazil's national currency, the fiat, is still a shitcoin. And yeah, it's something that it's maybe an impression that I see more people using the savings than looking for like I think it's a different like user profile for those looking to savings and those looking to maximizing returns. I don't know if I'm missing something here because like I didn't talk a lot to people in these places. So yeah, it's I think we are like slowly walking to this path of like moving on from saving to yielding into spending. It's like I had like one part of the conversation with Mike from Etherfi. I actually just released the episode, and as they're building the new bank, a lot of their customers is on the on emerging markets. Brazil is the biggest market for them, and this it's finally starting evolving, like the savings and the yield and all this stuff. It's an interesting observation you made.
Yeah.
Right.
Yeah.
So do you wanna add something?
Just to add one thing. So
Yeah.
I mean, I would say, even Strata's vision, I would say, is to sort of serve this global conservative capital, and to onboard it on chain with low risk, I would say, transparent, scalable crypto native yields with like minimized crypto native risk, especially with the senior tranche, and at the same time serve the high yield demand from DeFi native users with the junior tranche. So yeah, I mean, as Ramiro was mentioning, digital dollar adoption is rising. Next big thing, or the next demand from these users will be like the yield on these digital dollars. And we believe that like these users, they since they are like either being institutions or like TradFi savers kind of profile, they want yields that are sort of uncorrelated as well as better than what they are getting in legacy world. And and I think especially in this environment where we are looking at maybe like a couple of more rate cuts in next 4 or 5 months. So I think digital dollar yields on chain will be quite attractive for this kind of capital, and if you can offer these yields with minimized crypto native risk. So I think senior tranche within strata structure can be quite attractive, and I mean really can help in bringing, I would say, these global conservative capital on chain.
I think that everyone has very short memory, and they think that 4.55% T-bill rate is just something that is going to stay here forever. And I think everyone has been accustomed, like, okay, I'll just move to like tokenized T-bills or something, right? But once you see that going down to 3, 2, then what the sort of safe crypto native yields become. That's when people
way
start
more attractive.
asking,
And this is my my trigger, like the real Cambrian explosion of like crypto yield adoption. Yeah, let's see. I think it's something like we could go on like for an hour or more on this topic. So yeah, let's move on to the ecosystem choices. Like why Ethena rather than another ecosystem?
I mean, Vish, I know you're going to go into a deeper question, but I think the answer is obvious. I mean, there's nothing as scalable as Ethena, right? In terms of crypto native yield. If you talk about the definition of crypto native yield, then you think about Ethena, right? I mean, look how they have scaled packaging, like on the one side, the carry of like staking ETH as the original concept of Ethena, and then the basis trade. And I think that they've done it and they have executed in a way that no one has. So that's why we set out to build on top of what we thought would be the main crypto native yield that this conservative capital will look at when accessing on-chain finance. But Vish, I mean, you probably have deeper.
So yeah, I mean, Ethena sort of pioneered this tokenized basis trade, or you can say like a very first crypto native dollar at this mega scale. And then I'd say even so that's basically about the the stable coin part. About the yield, I would say the yield is sort of represents the demand of leverage in CeFi, right? Funding rates, and nothing like that existed in DeFi before Ethena. And like in DeFi mostly I would say like like Aave, it's very DeFi native yield and represents the demand of leverage on chain. So they made, this kind of accessible to everyone. And with the composability, they sort of achieved the DeFi, distribution as well. That really helped them, in growing quickly, and like the yield, if you look at more in a granular way, it's uncorrelated to, I would say, to TradFi yields, as well as to some extent DeFi native yield as well.
Yeah.
And historically, if you see, it has like comfortably outperformed every, I would say, DeFi native or TradFi yield source since Athena's origination. And like institutions, they sort of want the similar sort of setup that they have been using in TradFi. So for them it will be sort of very difficult to trust basically right away this you can say like non-custodial part. For them they have difficulty to understand self custody. So like Athena is sort of
It's,
like a setup that sort of
everybody
at bit,
gets it.
yeah, intersection of like a institutional custody, you have DeFi distribution, you
And
have basically yield that is being generated from C5 funding rates. So perfectly fits into what institutions are demanding. So yeah, I mean that's why we started with Athena.
It's the only like scalable and product that can fit this right now, right? And so yeah, it makes a lot of sense. I just wanted to like to hear from you guys like how was the thought process to creating this. And I asked earlier about Pendle and Strata, and right now we have a big like a symbiotic relationship between Athena, Pendle, and Aave. With like Aave, I think has like a $5 or $6 billion in USDe related deposits. And how like does Strata play a role in this relationship in the future, or not just with Aave or with any other like money market? How like the Strata fits in this puzzle in the future?
You can take Vish if you want.
No. Yeah, go ahead.
I mean, how do we fit in? So we on the Athena Pendle.
Do you fit in? My bad. Like or how or do you see like Strata getting this puzzle too? Yeah, I was missing this part of the question. Sorry.
Yeah, I mean, of course. So we just bring another level of not only composability, but I would say structured products to this layer, right? So what you have right now is we have a way of investors or sort of market neutral funds to sort of create this from the one size fits all strategy that Athena provides, and the sort of fixed yield sort of product that Pendle provides, sort of looping or sort of whatever sort of composability you want there, right, in terms of a strategy. But with Strata, what you add in the middle is a layer for different types of investors. So not only you can do a similar trade, but you can also tailor a risk reward exposure to that trade. So you can either go through the PT, you can go through the PT of the senior, you can go through the PT of the junior, you can go through the junior directly. So it just adds another level of complexity and sophistication to that same trade. In terms of the borrowing demand, of course, Aave brings scale unmatched in DeFi, right? I mean, any other money market has, doesn't have that liquidity, but that's something that's definitely, like our North Star for everyone in DeFi to access Aave. I don't know, Vish, if you have a better answer or like a more robust.
Yeah, I mean, yeah, just to basically, I mean, you pretty much covered everything, but just to add, like, with, I would say, since, both products, they are, composable, and the idea is to sort of, offer basically two tranches that offer, sort of tailored, risk reward access to Athena's yield. And, the same trade that you were mentioning, basically, this Pendle, Aave, Athena, sort of, it has almost like, 50-60% of the TVL of Athena, as well as I would say Pendle, comes from, this Aave, Athena, Pendle, the composability that it offers and a lot of looping involved. So, so right now you are just doing, this looping on, again, this one size fits all yield product, which is SUSD or, like USD or like the Pendle assets that are built on these assets. But now you can do the same, looping or, like whatever your delta neutral strategy is with more, like these two products that suits your, risk reward profile. I mean, if you want more predictable yields, because, on Aave or, other lending protocols, you have variable yield on one side, essentially you are borrowing the liquidity at variable rates. So, and on SUSD side, basically you have, again, variable yields. But if you have, let's say, just plain vanilla, senior USD, it gives at least the predictable floor on the yield side. So, you can sort of have more, I would say, like profitable, and more, I would say, predictable, yield on your, on your delta neutral strategy. And yeah, in summary, I would say, it allows more composability and more, tailored access to, whatever the delta neutral strategy that you want to build.
So going on the risk management side, and after like all the events we had like on October 10th and 11th, depends on the time zone you're in, and although DeFi was like less impacted than Sexes, the USD on Binance, it doesn't matter if it was like their like Oracle design problem, but it happened, and Binance is still like the most like has the biggest weight when using like oracles for like most places that I know. I'm not deep into the Aave Oracle, into the Morpho, but from the ones that I read like years ago, Binance used to be like the heaviest weight, and the USD was is hard pegged on Aave, and this hard pegged to one. For those who don't know, the USD is like automatically pegged to the USDT price on Aave. This is what a hard peg is, and people say that it's safe DeFi. It could like have like a huge cascading and ripple effects, even though Ethena was completely solvent and over collateralized. And how like do you see like this uh, catastrophe, like let's say like this, playing a role in how people will like doing their risk management, even like retail, and of course like many institutions, since like retail don't do a lot of risk management. And like how do you guys see this, how do you see this impacting DeFi moving forward, and w- does it like how does it like impact the view on Strata?
Yeah. So, I won't really, like dig deeper into the details, like, what happened, because I think all the, you can say, the dissection, has been done on, like Twitter. And I think it's mostly, I would say, like the information is publicly available, like what happened. Basically, nothing was wrong with Ethena, or I would say like, overall with DeFi. Like in summary, I would say, it was more like another win for DeFi, over CeFi. So yeah, like the spotlight was on the risk management part, So basically, right now, so basically, there are so many, volatile assets. There was like huge, liquidation cascade. It did not really impact, I would say, on chain, sort of digital dollars, or the yield part. But since like events like this, what the Aave things we were saying, this liquidation cascade, this CeFi related risk, can trickle down to DeFi as well. You cannot really, deny that we survived this time, but maybe, next time, this can basically trickle down. So it has sort of, like highlighted the importance of, risk management. Doesn't matter, TradFi, CeFi, or, DeFi. Historically, if we see, the kind of capital that has existed in DeFi, mostly speculative capital, don't really care much about the risk. Everyone wants to have like the high rewards, highest yield. So but yeah, events like this, especially in this environment where you are seeing this DeFi and TradFi converging. So yeah, I mean, there is spotlight on risk management part. So yeah, I mean, since product like Strata, what we are building, risk tranching, it allows to basically this two token structure that we have plays a significant role in risk management. So allows the senior tranche to transfer the risk to the junior tranche, which is sort of ready to take the extra risk in return for extra yield. And senior tranche sort of enjoys the the safest way to access the underlying yield. So yeah, I mean, basically event like this is sort of I would say bullish for a protocol like Strata, and any other protocols where risk management is sort of key. And as we say, it's better to transfer the risk than manage it. So yeah, I mean, I would say in summary, it's sort of bullish for what we are building, bullish for Strata, bullish for restructuring.
All right. Yeah, got it.
To that, Thiago would add, I mean, to what Vish was saying, I mean, I think DeFi or on-chain finance has done a big, has played a big part in democratizing a lot of yield sources that weren't possible before. A lot of this, like for example, Ethena's strategy, right, or other strategies similar. Usually, those were accessible only to like big investors or sort of big wallets in TradFi through hedge funds or others, right? What DeFi has done is that it allows it to be accessible by everyone, irrespectively of their size. However, right, that doesn't mean that the risk is off, right? So I think that's one of the things that DeFi is still learning, right? One thing is accessing this sort of returns and accessing more strategies and allowing more sort of decentralization and irrespectively of the size that you have. Another thing is the risk that is involved in those strategies, right? So what we are looking with Strata is to democratize so the access of crypto native yields even further, more than what is usually being achieved in DeFi, from one size fits all strategies to this sort of senior junior that essentially takes the allows users to access and tailor the risk reward preferences if they're conservative, retail, whatever they are in terms of savers, or you have DR allocators on the other side, risk taking but with the same composability, right? So that's the whole point.
Yeah, got it. And man, do you think like these events it is bullish for Strata? Like I also agree with this, and it's like people looking for risk management. And on the other side, you guys launched it like basically 1.5 days after the event was done, and you have like the junior tranche. The junior tranche benefits from like a higher, because of Athena, higher speculative moment. It's better for the junior tranche. And right now, it's the senior has like 92% of the TVL on the migration. Do you believe like these events like it will affect the junior tranche? Do you think it will affect the junior tranche adoption, or is just like a small period where like the market's still settling down?
Yeah. So yeah, I mean, like I would say like so many people were asking us that, are you guys sure to launch on Monday? Like after what happened on Friday, especially like people were sort of concerned about Athena and how the yields will look like. I like, see, the protocol was designed I mean, it's not really a stress test for us, This is for what, the protocol was designed for, So basically, senior transfers this risk, volatility, as well as, the counterparty risk, the junior underwrites this risk. And, whenever basically, Athena's yield, they go above the benchmark rate, they are going to get the leveraged, exposure to Athena's yield. So right now we are already seeing, I mean, the drawdown in Athena's, yield has passed. It's recovering, slowly, and looks like, very soon, it will be above the benchmark rate. And, like you correctly pointed out, like, 92% of the TVL is sitting on the senior tranche. So, I mean, that's how we sort of like wanted the protocol to perform as well, like the risk is dynamically being priced, by the market. So yeah, I mean, basically, as soon as, Athena's yield, funding rates go up, and, Athena's yield, they go above, benchmark rate, we can see some, I would say, crazy APYs on the junior side. So roughly, I would say, if everything stays like this, and the TVL ratio stays same, Athena's yield as, let's say, something like 5%, then we can expect something like 35%, even more than that, on the junior side.
Right.
So essentially, that's the trade-off between basically these kind of products. Essentially, you are underwriting this volatility risk, and if you look at historically long term, Athena's yield, they have been most of the time they have been above the benchmark rate. And I mean, essentially that's what the junior tranche is betting upon. Whenever yields go above, they enjoy that leverage upside.
Do you have a target for like the distribution between the junior and senior, like weights?
The model is dynamic. So what there is a minimum coverage ratio that needs to be maintained as part of the sort of the circuit breakers, or the sort of the design. But the whole point is that, given that there is no target, no intervention on our side, that makes the sort of that's the beauty of the junior tranche. It's a market priced insurance, right? It actually behaves based on whatever the market demands more senior, junior, and dynamically allocates the sort of returns to sort of I would say adjust the demand on both sides.
And I would say broadly, the objective is, senior should have always a coverage, from the junior side, and junior should always have a leverage to the underlying yield. So when markets are normal, I mean, how much leverage or how much coverage is essentially priced by the market.
By the market, I got that. Do you want to add more?
To add to, I mean, what we were discussing, Diego. So we had a lot of questions on who would buy the senior, right? Because there's essentially lower yield. There's a lower APY, right, on the senior. But now we have the questions like, okay, who's going to buy the junior? So what we like is that, because we had the question of who's going to buy the senior, and now we have the question of who's going to buy the junior, implicitly who's going to buy the junior question answers who's going to buy the senior. Right? Just because you're asking one, you're essentially validating the other one, and if you're validating the other one afterwards, you validate the other. So we like to say a very simple answer: the market.
That's the beauty of the system, right?
That's exactly the point of the system, and that's what you already see in TradFi. It's just that we are seeing it more and more demanded as sort of conservative capital goes on chain, right? They need this sophistication, and they need DeFi to also play to the similar rules that you see in TradFi, but taking into account that you still need to have DeFi programmability and the same composability to make the product make sense, right, for users.
That makes sense. And like regarding like the new products, you mentioned earlier that you could talk about ETH and Bitcoin, maybe Hyperliquid, and Can you share like what's next that you have like already in development, and what are you aiming to launch like still like in 2025 on the product side?
Yeah, I can touch on that. So the next strategy that we're launching is HLP. So
cool.
What you see in the market is basically, you see some versions of tokenized HLP, but we consider that a structured yield product on top of HLP is more
Makes more
robust.
sense.
Yeah, because the senior is much more composable. Money markets can underwrite the risk, given that essentially instead of underperformance, what the senior transfer to the junior is P&L risk. So any sort of potential strategy losses, right? So P&L. So you see that HLP has some downside. It has some drawdown. So essentially, that's transferred to the junior. You still have a very attractive product that is going to be lower yielding, and then you have the junior, which essentially provides leverage upside on HLP, right?
Yeah.
And that fully composable both, right? Within Pendle, within money markets. So we already have quite a lot of sort of partners in the hyperliquid side. We had a lot of conversations that said, a lot of people said, we don't know if the HLP product might make sense. And then after the latest occurrences in HLP, then everyone is saying, okay, that is a very attractive product, because essentially with this products, we can make the lifeblood of hyperliquid, which is the sort of the HLP vault, sort of be used more and more within DeFi, which currently it isn't that much.
Yeah, it can open like a whole like new layer of composability on top of it, because you're using like something like I see a lot of people looping PTs. I don't like to loop PTs, because if like I'm doing like Ethena and suddenly the token pumps and the U token spikes and my PT might get liquidated, and I was like, I don't want to play this. It's same. I think it's the same as HLP. A lot of people park money there as is like risk free, and this is like completely the opposite of a like a risk free deposit. And the senior can add like this risk free quote unquote on the HLP, and makes it more like usable. It makes sense. And
yeah, we unlock that liquidity, because right now you have like 600 million parked in the HLP vault, but it's locked there, right? I mean, we sort of tokenize it in the sort of in the best way for it to be then further sort of rehypothecated into hyper EVM and other EVM chains, which is essentially exporting HLP yields into other.
Yeah, this is interesting. And I heard people talking about and imagining like exporting the HLP, talking about like talks about products, but never anything concrete. And yeah, if you're doing this, probably gonna be like interesting, like plugging into money markets, like more for Euler, and that's something that's interesting. I can like see this getting like a decent traction, at least. And
Vish,
do you want
to add something?
No. I mean, just to add one thing, I mean, there are, I would say, 2, 3, tokenized HLP products out there. But I mean, as long as you do not really take advantage of, the composability that DeFi offers, and mostly, it's about basically to have plenty of liquidity, that can be borrowed against, your assets. So right now, I mean, all these, tokenized HLP products, they cannot be really used as a, collateral, in money markets. But, with senior tranche on HLP, you get, access to, the uncorrelated, yield that is, I would say, uncorrelated to both DeFi as well as, I would say traditional rates. And, since senior side is essentially an over-collateralized yield-bearing dollar, so the NAV is always greater than 1, So yeah, I mean, it's quite sort of attractive, and sort of makes more sense for all these money markets to integrate the senior tranche, and yeah.
Do you guys plan to add something like I mentioned EtherFi earlier, and do you guys plan to add something like EtherFi, like liquid vaults? They have like these vaults to earn yield like on ETH, on BTC, on Hype. and on stables right now. Do you plan to add something like this? And for people, this kind of integration, like to neobanks and to like plug into yield into DeFi neobanks? Do you have something like this on the pipeline, or?
Yeah. So I mean, like, we want to offer, these structured yield products, senior junior tranches on, multiple yield sources, like since you mentioned, this liquid vault by SFI. So, I mean, we have, I would say, like inbound interest from, some vault managers or, curators, you can say, to tranche their, existing managed yield vaults, similar to what you see, like Etherfi. I think it's Veda's vault managed by, I think, 7Cs.
It's
So
7Cs,
yeah,
yeah.
something like this, we will, I mean, these are in our, roadmap, I would say short-term, roadmap to build upon. And regarding the distribution, you mentioned about neobanks. So as, I mentioned earlier, we want to target, the global conservative capital, with our senior tranche. So essentially, whatever sort of way to distribute, to sort of reach to this, conservative capital, either it's already in DeFi or in TradFi, so definitely, we will use all these, platforms to distribute, our senior tranche. Yeah.
Yeah, I mean,
Man, you
sorry,
go.
I mean, the UX of the products is there are ERC20 tokens, right? I mean, there are ERC for 6 volts, sort of
Yeah.
tokenized volts,
I think
ERC20
it's for
tokens.
6 to 6 volts.
Yeah.
Yeah.
So in terms of UX, there you can plug them or you can access them anywhere, right? So in the same way that you access any other asset, that could be more speculative. Let's say when you're buying a token and you're going for the price, this is more of a savings product. So the senior can be distributed anywhere, right? It's just a matter of how we structure a roadmap between scaling horizontally and then distributing these. We see a lot of demand still in DeFi, and then sort of Web 2.5 is the next step, right? Once we establish and sort of get organic growth on the platform, the Web3 side.
Yeah, no, when I ask new banks, I ask like about DeFi native new banks, not like traditional ones, like EtherFi, Plasma One, Mento, your and stuff like this. Not like Web 2.5 yet.
The thing is, Web 2.5 is where the size is, right?
Yeah, it's true. Yeah, the big boy money. Yeah,
user size. I mean, you're talking about millions, right? I mean,
it's
you
true.
cannot compare anything to Nubank, right? I mean, Brazil,
No.
right? I mean, Nubank is just the
It's
scale.
huge.
Nubank probably has more users than every single product
Anything in crypto.
times 10, right? So it's
yeah, I think it's like it's I don't know if the whole industry is like 500 million users or something like that. The whole like neobank industry. Mike gave me the number, but I don't remember. But it's pretty big. Yeah.
Are you talking about Revolut in there?
Yeah, Revolut.
I mean,
I think it's
that's
500 million
already,
users.
yeah, already 15% of that is only Revolut. So for sure, I mean, that can definitely be the case.
Yeah. All right, man. And still in the products, you're launching HLP, and in early conversation we talked about like Plasma, and you guys are launching there. And what are you launching in Plasma?
We're bridging our assets. So so the senior junior USD tranches, we're going to deploy them on Plasma. Working with layer 0 on that and with the Plasma team. To essentially bring those. I think that the Plasma ecosystem is very is suited for this sort of yield bearing assets, and our products are essentially that. So we're going to be working with the team and have more announcements really soon.
Cool.
And then we're working with one Plasma native team on sort of creating the same structured yield products on top of them.
Nice.
So that's something that we'll announce, I think, later this year. But essentially, it's going to be a similar case to what we have with Ethena, where there's a yield bearing asset that is a one size fits all. It's just accessing a different strategy, right? Instead of doing the basis trade, that sort of arbitrage, sex arbitrage trade. So we're going to offer the same product on them. but again, the hurdle rate, the way that it's structured, because it's our infra is modular, is going to be different, right? That's the whole point. We can quickly scale, but the way that it's structured, or the way that it's actually that the parameters are set, is just going to be particular to that strategy.
All right, got it. And still regarding products, like I asked you like earlier in the beginning, when like how can you like we see some like mortgage-backed securities and they package like risk transfer products on top of that, and like we got the real like the global financial crisis in '08 with like people repackaging. Correct me if I'm wrong, like but they repackaging like bad bad products, like risky products as AAA secures, and this bad CDOs, and this was like looping like an infinite like leverage on top of this, and this triggered the crisis.
Yeah.
So if you guys do you guys like plan to build like a basket products in there? If you plan to do this, do you think like if like bad risk management by curators can create like something like similar to that but in like smaller scale in crypto?
Yeah. So, definitely, I mean, right now, we want to sort of scale with some strategic, underlying yield sources. But I would say around 8 to 9 months, from here, we'll be, sort of looking into, you can say, meta vaults. But we do not really want to enter the allocation game here. We do not want to become allocator on ourselves. So mostly they will be institutionally managed yield vaults. So essentially, it allows these curators to allocate to more, you can say, long tail assets, or long tail strategies,
Yeah.
because and across the you can say risk spectrum, from low risk, low yield, moderate risk, moderate yield, to even like very high risk, very high yield strategies or assets. And essentially, as the risk is transferred to the user that is ready to take that risk, so it allows them to sort of like allocate to more, as I mentioned, like more sort of like across the risk spectrum. And essentially, junior enjoys very high yields, and senior gets the low risk access to these strategies, at the same time high yield as well. So yeah, I mean, definitely, we will have these basket of different yield strategies, or you can say meta vaults, but not managed by us. And like basically, at the same time, once we have enough, you can say, traction, number of users, we have achieved, you can say, product market fit with a couple of first strategies, as well as we have proven, you can say, that there is a demand for particularly risk tranching. Then we can have basically more tranches as well, not just senior and junior, but we can have like a mezzanine tranche as well, or even more than 3 tranches that you see in traditional finance.
No, cool. Got it. And man, now moving on to we took like we're for a long time here right now. I don't want to take much more of your time. I just have a few more questions. And like regarding the campaigns, you just finished season 0 with like the pre-deposits vaults, and now we're on season 1 with the 2 junior and senior tranches. And can you, if you cannot comment, just let me know. But can you like give me like some? Do you have like a timeline target for TGE? And regarding season 0, season 1, have you defined allocations yet? And percentage of supply? Any incentive, future incentives to converge? If you cannot talk about it, just like just say what you can, and we move on. All right.
Yeah.
For sure. I mean, what I can say is, season 0, season 1. I mean, season 0 would definitely be we combine with season 1 in terms of doing our. Okay.
Oh, that's some phone ringing. That's all right. No worries.
Sorry, Vish, if you want to go ahead.
Yeah. So just to continue, like what Ramiro was saying. So yeah, I mean, we launched our season 0 end of July, and launched our mainnet product and season 1 last week on Monday. And the season 1 will last until mid January. And so I mean, for, I would say, any type of like future airdrop allocation or whatever, our idea is to sort of combine both season 0 and season 1. So there is no like separate allocation for season 0 or separate allocation for season 1. And so the idea is, I mean, we have some internal KPIs, like when do we want to do the TGE. So I mean, based on those KPIs, we are very confident that we can achieve them maybe like early next year. So yeah, I mean, expected date would be somewhere around early Q1. But again, it's not like really definitive. Really depends on the market conditions and the growth trajectory we achieve. But yeah, hopefully early next year. And yeah, about the allocation, I would say like it's too early to comment on, but yeah, I mean, it will be lucrative enough for everyone.
That's a point to know.
To add to that, Thiago, I mean, some of the internal KPIs, I mean, we definitely want to capture around 10% of Ethena's sort of yielding or yield-bearing token, which right now is somewhere around 500 to 600 million in the senior junior tranches, as TVL. That would be the target. Then we're looking to capture, a significant portion, or at least a portion that shows product market fit, right? Because a TVL KPI, or I think a lot of products in DeFi, they measure TVL, but a lot of users, or a lot of the projects understand that TVL is just an evidence of a certain other KPIs met, right? Because right now we have over 4,000 depositors, so with 120 approximately million in our senior junior tranches. If we're talking about 500, we're talking about more than 10,000, right? So that's already users, integrations, and then more products launch. So we also want to launch the HLP product, so hyper EVM integrations. Let's say a percentage or a significant percentage of the HLP vault that is tokenized through us and that is rehypothecated and used in hyper EVM. So TVL just means a lot of other things that have been achieved, and to us that's sort of an indication of product market fit. But we're not really focused on the timing, but we're more focused on launching when it makes sense for the product to be bringing added value to the users.
I think a lot of people will be happy to hear this by seeing like what a lot of teams are doing with like milking people and trying to launch just to like getting exit liquidity from the users. It's going to be refreshing for a lot of people to hear this, and because there's a lot of like shenanigans happening on TGE land in this market, especially in 2025. And
I mean, no comments on that really. We focused on what we're doing, so we don't really look at other projects. We definitely look at our partners. Like we look at Ethena, we look at Plasma, we look at the Hyperliquid ecosystem, our partners in Hyperliquid. I think that the projects that are focused on their user show, and again, products that are focused on the user show, and the way to show that in a way is TVL, right? Because that's just a really good metric of user trust.
Adoption trust, right?
Adoption. I mean, you cannot. I mean, Ethena, right? I mean, you cannot get 15 billion from 10 users, right? I mean, it's a lot of things that why you get there, right? In terms like the good ecosystem, like the HLP vault, it has 600 million. That's not, that's not just because, right? That's because there's a huge trust in the entire ecosystem around that, and so the other projects that are building on Hyperliquid that we're building. But that's nothing else to say on that side.
All right. And I wasn't like talking about any specific project, just some observations from like what I'm seeing since a few years ago, and especially like this year. And so on the token side and future utility, we're moving on to like a way like investable assets, tokens like that can represent something. And can you guys comment on that, on the future token utilities for Strata? It's you design already, you're still thinking on design.
Yeah. So yeah, I would say, I mean, nothing has been, concrete in terms of design yet.
Right.
But yeah, definitely, our, I mean, say, like it will be very much similar to, Athena's, governance token, ENA. There will be a value accrual mechanism, and that's why we do not really want to, sort of, rush, that much on the TGE, as we have, set up some internal KPIs, that ensures like enough, I would say, protocol revenue, and sort of enough, value
True.
accrual to the token. uh, in terms of, I would say, utility, I think not something, very out of the box, but yeah, very very similar to, the way, Athena's governance token works.
All right.
And yeah, mostly the token will be inspired from, Ena only.
All right. Great, man. And before we wrap up, what do you guys, what is the end game for Strata?
Okay, so I think, as I explained earlier, with Strata, we want to onboard, global conservative capital, especially, those who have been still, existing in, TradFi, haven't really, moved on chain, with, these low risk, transparent, scalable, crypto native yields with the senior tranche. And at the same time, I would say, serving, the high yield needs of, DeFi native users. And yeah, I mean, we want to sort of, scale, uh, you know like you can say, like a building a distribution layer,
Yeah.
on top of existing yield sources, in order to, sort of democratize, crypto native yields.
Got it. And
I'll give my take to
yeah.
complement Vish's. So, I mean, the way we see it internally, DeFi is definitely converging with TradFi, and that's happening right now. There's been a lot of, I mean, there's a lot of indications of that, and Ethena is one case. And the one thing that we see is that in TradFi is, or the way that investor demand works there is not the same as it works in DeFi, right? So just because there's a supply of crypto native yields or strategy, it doesn't mean that there will be a demand that just perfectly fits that. So the way that we see the protocol going further is just a complete suite and ever growing horizontally of the structured yield products that meet this tailored risk reward exposure that sort of sophisticated investors demand, right? And
Yeah.
that will allow sort of DeFi and TradFi to converge, because you have it on the one side, sort of composability, programmability, but at the same time you have the sort of sophistication of or product structuring that you expect, and that sort of TradFi allocators expect when they're entering a new asset class. So that's one thing that we have as a north. But yeah, the future will tell. But we think that this is the right way.
Yeah,
Yeah.
I agree. I think you guys are on on the right path on the side. And man, there's two questions that I always ask for the guests, and now I have like two of you. So first, I want to like give me like how do you describe Strata in one sentence?
Yeah, so Strata is basically a perpetual risk tranching protocol, that is designed to offer structured yield products on crypto native yields.
That's cool. And man, thanks
And
very much for
yeah,
coming. Yo, thanks very much for coming. And this is on the screen. Are you guys handled on Twitter, right?
That's right.
And yeah, all right. So we're gonna tell everyone to follow you guys, follow Strata, and for before like final words and the last question, this I want an alpha for the audience, and like you can be about anything. It doesn't need to be like a Strata, but a token. It can be about anything. Just like one alpha for the audience, one from each of you.
Vish, I mean,
You can think about. Take your time, man.
alpha for the audience.
I would say, I mean, we are currently running our season 1 and running our points campaign that is, I would say, closely sort of designed with Athena. And like apart from getting, I would say, tailored risk reward exposure to Athena's yield, you get incentives on top of the native yields from Strata as well as Athena. So we have basically one of the, I would say, highest multipliers from Athena across the ecosystem. So
Yeah.
On my side, I would say stay tuned because we have some big things coming. So I think we already gave all the alpha during the podcast. More alpha has been given than to anyone on what we're doing.
Thank you.
So
see, guys,
we haven't
a lot of alpha.
Yeah,
but it can be a new alpha. It doesn't need to be regarding Strata. It can be regarding a work in the industry or looking like about anything. It doesn't need to be about like crypto specific.
Then I would say look at Athena, look at Hyperliquid, and look for what is coming in the crossover of that. Definitely would suggest people to do their due diligence, do their research, because there's a lot of things that are hidden, but that are hidden in plain sight of what's coming there. And then I would also say to look at Plasma, because there's some really cool stuff that they're cooking there. That I don't think we're I don't think that people underestimating what the scale that they can achieve. So I would definitely say look at that. I don't know if you have anything, Vish.
Yeah. Can you hear us,
Vish?
Yeah.
I don't know if you have anything else.
No, I think I mean that was it. I think just keep a close eye on what Athena is cooking in the Hyperliquid ecosystem, and there are I would say Strata will be enhancing those products with our restaurant protocol. So even more interesting things will happen in Hyperliquid ecosystem.
Cool, man. Yeah. Guys,
rewind this podcast and rewatch all the alpha for an hour and a half.
The podcast was long, so you guys, if you came to the end, like pay attention. There's there's some alpha, explicit alpha. There's some hidden in plain sight alpha,
Easter
like
eggs.
Ramiro mentioned. Yeah, there are Easter eggs. You guys just rewatch it. And man, thank you guys for coming. This was like a very comprehensive and a great conversation. Yeah, you guys clarified everything and more than what I was expecting. So yeah, it was great. Thanks for your time. 1.5 hour of conversation. Thanks, Ramiro. Thanks, Vish. And do you guys have any final words?
Likewise.
Thank you, Thiago. Like I said, this is the first time we're doing a podcast. So I think, I really appreciate it. We would love to jump again. I know that you have a lot of friends that are our friends as well in the space, and we would love to have maybe a new appearance with some of them, talking about Jorge, talking about the other guys. Hopefully we can share a podcast with him.
That would be great.
Yeah, we can talk about others. Yeah, we can talk about crypto in general, not only about Strata. We're very plugged into the space, and we hope to see you in person at some point. I don't know if you.
Probably it's conference. Even if you guys not going to Argentina this year, maybe token next. And all right, thanks guys. That was a great one.
Thanks, Thiago.
Thanks, Thiago. Bye bye.
Bye bye.